Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Hello, investors. Back in the host seat today, Don Vandenbord for our weekly Revere podcast entitled Your Money. We're going to, no fluff, we're going to get right into the markets. So let's get started. What you can see right here is a chart of the S&P 500. And if you've been following us on videos, there were some key some key events over the last 2 weeks that we've been focused on to determine whether or not the market was going to be able to break out of this tight range after the follow-through day. One of the events was reaction to earnings, which has pretty much been positive, especially for some catalysts in the AI sector. And then this past week, we were looking at some key inflation data that came out. PPI Wednesday morning before the close. CPI Wednesday morning before the open, and PPI Thursday before the open. CPI came out in line. That's consumer price index. That's what people are paying for goods, and no big issue there. Somewhat positive reaction, but not the overwhelmingly positive reaction that we were hoping for. Then PPI came in either in line or better on Thursday, and we got the action we were looking for. We got a breakout of this range on the S&P 500. And today we're giving a little bit of that back, but it's an inside day. An inside day means today's low and high are below the yesterday's high and above yesterday's low. So it's just a consolidation day. We're seeing some mixed action in AI related names. We're seeing the recently leading sector, some money flowing out of there and going into some of the more physical components of AI. And speaking of AI, next Wednesday, I will be a guest on the Investing with IBD podcast with Justin Nielsen. That is free. It's live on YouTube. And we'll be talking about the Revere AI 100 index and how that's helped us since late May when we put that index together. So let's go to a 60-minute chart right here. And it's very clear what we're looking at. You can see this tight consolidation that we've had since last week. The breakout, that put in a high right out of the gate. That's one of the negatives about it, I would say. But we finished positive on the day. That was Thursday. And you see us giving a little bit of that back today. Really what we're focused on, we had been talking about this tight range between 7,700 and 7,800. We want to get back above that 7,800 level to keep that breakout intact. Ideally, we don't want to fall back into this tight basing range that we saw. That would be about below 7,765-ish. And we certainly don't want to break below 7,700. We've been adding exposure and getting some pretty good results since the follow-through day. That can change in a hurry, though, with the market. As you're aware, we're also not in the best seasonality portion of the market, even more so when you add in the midterm elections. But we've got our levels. Highlighted on the chart right now is a 5-day simple moving average. That's the light blue line. The next line, the purple line, is the 8-day exponential moving average. As long as we're above those levels, absolutely nothing wrong with the market. You can't complain in any way, shape, or form. But if we start to break back into this tight range that we had on the S&P and break below that 7,700 level, we will violate those moving averages. That'll also bring us to the next level down that we would be tracking, which is this 7621 prior high that you can see I've got identified here. That would be the next level down. That also happens to be where the 21-day exponential moving average is. That is our green line here. And if we get back down to that level, that the 21 is going to continue higher. So we will hit that before we'll hit the 7620 level. Why do I bring these levels up? Because every night in our videos, we talk about what the keys are that we're watching, the closest support level and the closest resistance level. Right now, it's all-time highs for the S&P as the closest resistance level. That's 78.1670. And then the next level down right now, the 8-day exponential moving average, which is right around 77.17. So if we break the 8-day, the next level down is that round number, 7,700. Start breaking below there. I would expect that we'll start hitting some stops on our individual names. It would be a failed breakout, and you know from failed moves come fast moves. And how do we know that? Well, it's an old Wall Street saying, but it's been no clearer a failed breakdown than 3 weeks ago on Wednesday. The Leopold Situational Awareness hedge fund blew up. That put in a shakeout below the 50-day moving average. It put in a bottom, and we've been off to the races since then. From a 4-day standpoint, to where we had a follow-through day and made new highs, and now consolidating sideways, making new highs on the S&P, as well as several of the other indexes. We'll take a look at those in a second, but making new highs there the last 2 days. But it's not about how much you make in the markets. It's about how much you can keep. So we're keeping a close eye on protecting the profits that we've collected this week. Let's go to the equal weight S&P 500, the RSP ETF, and you can see that looks just fine. It's outperforming the market cap weighted SPY today, and that normally means that value stocks are outperforming growth stocks. I'm going to take a look to the left where I've got about 250 tickers streaming constantly, and it's very clear. SPYG down 0.5% on the day. That's the growth half of the S&P 500. SPYV, that's the value half. That's positive by 0.1% today. So value stocks outperforming growth stocks today. Pretty simple how that happens. Money's been flowing into growth over the last week, and it's just a little bit of a reversion to the mean. Let's go to the NASDAQ 100 next. We'll check off all the indexes, and you can see while this is still in a base, has not made all-time highs because of the big underperformance when the AI trade was pulling back hard. But you can see back above the 21-day exponential moving average on the relative strength line, as well as all of the key moving averages, the 5-day, the 8-day, and the 21-day. And we're getting a golden cross of the 21-day coming up through the declining 50-day moving average. That's generally considered bullish as well, although it's just a trend indicator. It's a reflection of price over the last 21 days. NASDAQ 100 check. Let's go to the Dow Jones Industrial Average. This is a value large cap index underperforming below the 21-day moving average on a relative basis, but sitting right on its 8-day exponential moving average, which is flattening out. And again, the lack of relative strength there, just indicative of how growth stocks have been outperforming value since money started flowing back into the AI trade. We'll wrap it up with S&P 400 mid caps, and this is just riding the 5 simple higher to all-time highs. Made an all-time high today. Very nice there. And we'll wrap it up with the Russell 2000. Also all-time highs, trending above all key moving averages. Do note, however, that small caps have been a relative laggard. You see them just now, despite being at all-time highs, trying to get back above the 21-day moving average of the relative strength line. No chart is complete without a relative strength line on it, and this enhancement that IBD made to Market Surge a while back, being able to put moving averages on a relative strength line, is a very clear indicator of where things are over the short-term 21-day moving average. All right, we've got, since we're going to stick with AI as the theme for today's podcast. We're going to have 3 presentations. We're going to break down 3 key sectors and see how the leading names within those sectors, those subsectors of AI. We're going to start off with fiber optics / photonics and a new ETF that just came out this week. Connor's going to take us through that. Then we're going to go to the memory names. Ted will take us through that, and another new ETF for the NeoClouds. We had been using WGMI for a while. That was actually cryptocurrency miners that pivoted to data center providers. But there's a new and better ETF. We feel we like the way its components are weighted better than WGMI. So we're going to talk about that. Let's take it over to Connor right now, and the new ETF that he's going to talk about is LYTE, LITE, and this is making us in-house start. Before we would just, when we mention LITE, it would be LITE, which is one of the big components of fiber optics, but now we've got LYTE, so we got to be clear to distinguish between the ETF and the individual ticker. So Connor, LYTE, Round Hill Photonics and Optics ETF. What can you tell us?
Yep, thanks, Zhang. Yeah, so this was launched on August 6th, and this holds a basket of all the, optics and photonic names. Wish they would have launched this a little bit earlier, as some of these have had some big runs, but better now than never. And so, this is a big part of the AI trade. Optical connectivity has been very important to the AI, build out. And so this ETF gives you broad exposure to the whole basket, which in a group where these names have extreme volatility, big range, and you never know what piece of news could drop, having the ETF allows you to capture the alpha with eliminating some single stock risk. So one thing to note with this ETF is that it does hold a lot of foreign photonic names. I believe a lot of the big players are listed on foreign exchanges, but nevertheless, there's many US-based stocks in this. And we'll start with the first one. That's Coherent. And these stocks have had some pretty nice moves, and now they're potentially starting to base out here again. You can see near the highs, Coherent got quite choppy, and basically just the market telling you that maybe it needed a new catalyst, needed some more time to digest, and this one's starting to build out a decent multi-month base, letting those moving averages align. And very choppy, but with these names in a strong theme, we're always keeping them on our radar, with alerts if they become actionable. But this one, we're just monitoring this one for now in the overall theme. Next one is LITE as well, and that is the LITE, Lumentum, and this is actually held in Grotection as well. And you can see this one. They had a cut. They just recently reported earnings. This is one of the RS leaders in the group and fundamental leaders. And, initially gapped down on earnings, and then we sometimes call it the earnings shake and bake and close near the highs. And again, these stocks, no shortage of volatility. Then the following day, yesterday, it puts in a reversal. But again, as long as it never broke that earnings day low, and you had the bundle moving average support, and as you can see today, it's having a nice day. Earnings out of the way, one of the big institutional liquid names in the group, so keep an eye on this one to potentially emerge out of the space, break through that 1,000 Livermore level, and maybe this group goes on another run with momentum coming back into the AI trade after the Leopold low. And then next one is Ciena. Another one, more of a laggard in the group. But with that said, it is starting to show some character change. The ranges are tightening up a little bit. It's not as wide and loose. Strength is holding, and you could even argue this is like a mini inverse head and shoulders bottoming, forming out on the chart here. And it did hold the 200-day moving average. So long term, it still is in an uptrend. It briefly closed below it for about 2 days and then reclaim. That's exactly what you want to see. And so from a long-term perspective, the chart is still intact, and this one's, rounding out the right side of the base. And now we'll go into AOI. I view this as kind of the high beta name in the sector, and you can see this one's having a heck of a day. And again, this one had a very, very steep sell-off, over 65% off the highs, but it did find support right at that 200-day moving average. You got the RS line back above the 21, making another high today. And this one had a super tight kind of setup and reclaiming the 50-day moving average. So overall, that's very constructive action. Obviously, that's one thing I do want to know is, a lot of these charts have quite some overhead. Now this one has a lot more overhead than, Lumentum. But, as long as it can, not get rejected hard, and you just might need some more time to build out the right side. But this is super positive action that we're seeing in AOI. And then the last one is AXTI. Now this one, you kind of got some China risk. This was like a $5-6 stock not too long ago, has had an enormous move, and it's had an enormous move down, and now similar thing as the other optics names, found support at the 200-day, big move up, now putting in a multi-day flag, trying to get back above the 50-day. So this is another high beta name in the group, and then we'll just finish off with the ETF done. And what makes LYTE and what makes this ETF so great is you get it all. Some days AOI is going to be up 15% and LITE's going to be up 5%. So with the ETF, you get the high beta names, you get the quality institutional names, but you're not, and you get the whole basket, which is a lot better in my view than personally just owning an AOI, because the volatility is going to be massive. But if you catch it right, it can make an explosive move. So with the ETF, you get the whole basket. So this is a pretty cool ETF. Momentum's coming back into the AI trade, and this is one that we're watching, potentially get involved in.
Right, great stuff, Connor. Notable the components of this LITE the LYTE ETF, GLW Corning, which is one that we tracked a lot, have traded, a laggard coming back, but not included in the LYTE ETF. So always got to check out what the components are of any ETF and what the weightings are when you're looking to invest in it. Thanks, Connor. Let's take it over to Ted, and he's going to pivot to memory, and we're going to bring up the very well-known DRAM ETF, also issued by Roundhill. They've really had their finger on the pulse of this AI trade. Go ahead, Ted.
Thank you, Don. As we know, memory has been extremely hot theme over the last 1 to 2 years. In many of these stocks, SNDK, MU, WDC, STX, SK Hynix, part of the DRAM ETF has made some tremendous moves over the last 1 or 2 years. So right now, the question for us is, how long are we in this move? We've clearly had a big pullback from highs. Obviously, none of us knows if that was the top or not, but obviously digestion is needed, and digestion has happened. So we're looking at this for a potential turnaround situation here. Obviously, the DRAM ETF is still below a declining 50-day. We look at the RS line, it's still far off from highs as well, with the 50-something RS rating. But we are getting the first breakout above the 21 SMA here, so that's a good change in character. We look at the volume, 4 green days or 4 green bars in a row, back above the 8 and 21 EMA, but still below declining 50. So definitely some overhead here. But there's some positive news. I believe, Don, if I'm right, coming from Goldman Sachs or Morgan Stanley, just about SanDisk and the memory trade as a whole, still having great fundamentals. As we know, also sometimes fundamentals can be the best at tops. So that's kind of the two balancing forces or factors that we're weighing here. We're obviously going to go with price always first, but we are seeing some positive action in individual components with Micron, which Don is bringing up right now, breaking back above the 50-day moving average today. Backing off a little bit here, but it's negligible. It's right here. And then even stronger, STX broke above the 50-day moving average. This seems to be the price leader currently in this group, back above all key moving averages. You can see that, and also making higher highs relative to that 900, I think 6 level. It's a little blurry on my screen. You can see again, RS ratings in the 90s, so that's very positive. So that is a changing character for this name. We're monitoring this really closely as well. And I was reading into this. There's also another like a sub theme part of STX is that they're also part of data storage. And we've seen names like NTAP, even Dell, HPE act well as a group. And this you can kind of classify as a hybrid between memory and data storage. And perhaps that's why the relative strength is the strongest out of the classic memory names. I mean, fundamentally, at least in the AI trade, memory is still a huge bottleneck. They call it bottleneck. Everyone's on it nowadays. But even Elon, he replied today or yesterday to someone's post about AI agents, and that he still says few people understand how big of a bottleneck memory is. So if this isn't a super cycle, even though SanDisk, MU have made 1,000%, 2,000% plus returns, that doesn't mean they can't form another 6 to 9 month base before stepping higher from here. That could happen. We're watching for that possibility, and we're going to stay open-minded there. And just continue on, all these AI companies are advancing their agents. Elon, SpaceX, or XAI released their Grok bot platform, which is where you can spin up a lot of agents to do work on your behalf. And that's why Elon's commenting on memory. It's really crucial for agents because what memory does in the chip is that it what better memory or more memory essentially allows agents to quickly store and access the data, which is really what it's all about. No one wants an agent that takes forever to do the work. They want quick access to data, agents that can communicate with other agents with information on the internet and actually do work for you. So that's really the main thing with memory right now. And even looking more forward to the future when robotics come into play, memory will be just as crucial as well. So we're looking for these charts to heal themselves, which they are starting to. And it'll definitely be interesting again if they do.
Yeah, I've got SanDisk up here now, Ted. That this is one they had a big investor day yesterday, and sometimes these investor days are met with sell the news type of reaction. Not SanDisk. Big move up yesterday, and following it up to the upside today, running into the declining 50-day moving average. But as you mentioned, Goldman Sachs putting out a review on SanDisk today and upgrading it. And sometimes these upgrades are so that they can sell their stock. So the initial reaction could be knee-jerk in the opposite direction, but this is setting up nice. We've been talking for a while how if we could determine that the AI trade still had legs or if it was going to end is if these stocks start building the right side of their bases. And that's exactly what we're seeing with a lot of these coming back. Very normal area for it to pause today into the declining 50-day moving average, with it being the fifth straight day up off of the lows. And the one final one, Ted, SK high, which was traded just on the Taiwan exchange or the Hong Kong exchange. Now an ADR on the US exchange as well. So this is gives us another chart to refer to in the memory names.
One more thing on SanDisk, Don, if you could bring up a weekly on SanDisk. The reason why there could be two conflicting views is the fundamentals are so perfect right now, which is why fundamentalists believe this the memory trade can continue much higher. If we just look at the price on the weekly, this emerged from the 40s and 50s and topped so far around like 2,400, 500. Even from the base breakout down there, that's like a 4,000% move. And looking at the weekly log, you can see it very clearly. Two stage 2 uptrend bases formed, 3 defined legs as well. And oftentimes these moves, they make 3 legs up and then they at least have to consolidate for a long period of time, if not top. And we've done stage analysis many times on this show, and this is exactly where we're starting to see a potential stage 3 form. You can see the 30-week moving average has caught up the price. Price has slashed the 10, 20, and 30, and even the 40-week moving average is starting to catch up and flatten. But there are nuances. We've seen that with AMR a while ago, which is a coal name. It forms a stage 3 top, but it doesn't actually break down. And that's the key part. It resumed back into stage 2 uptrend. So that is a nuance with stage analysis that can happen. But what needs to happen is a base. And we'll see what happens here. You kind of only will know in hindsight if it's truly a stage 3 top, or if it's stage 3 top that looks like it's heading into stage 4 but resumes into stage 2 uptrend. And that often happens with super cycles. So really, we're just waiting and seeing. The fundamentals are perfectly intact. You can see it's just extraordinary. I mean, market search 13,000% year-over-year earnings in the recent quarter, like 400% nearly revenue growth, and we know about the bottleneck and supply and demand imbalance. So we're just waiting and watching to see how the chart forms.
Yeah, we're not bottom fishers or flounders. We're not going to try to get this off of the bottom, but we're going to wait for it to form a nice base and break a key resistance level to the upside. Thanks very much, Ted. Let's take it over to Todd now, and he's going to talk about NeoClouds. We're going to start off with the ETF WGMI, which stands for We Gonna Make It. This is still titled the CoinShares Bitcoin Mining ETF, but what it really is a bunch of Bitcoin miners that had pivoted to being data center providers of their infrastructure. And we're going to start here, Todd. But really, should we just go right to the new ETF?
Yeah, we could. Just to give you a brief summary of WGMI, it originally started, and each company or the general portfolio had to be at least 50% Bitcoin miners and or related to mining. And many of those companies have pivoted, over the last year to AI, high performance compute, data center infrastructure. So there's a lot of overlap to these. I shouldn't say a lot of overlap because NCLD, the NeoCloud ETF, which just came out on August 6th, is heavily concentrated in 2 NeoClouds, where WGMI is diversified amongst several names. And it's an ever-changing portfolio too. These are not static necessarily. The position size changes. But NCLD is a very nuanced ETF, okay? It's basically concentrated in 3 names: NBIS, CRWV, and IREN. And it uses a structure of swaps and using margin on the swaps by holding U.S. treasuries. So really, if you look at NCLD, it's got a 10% holding in NBIS, but it's got a 14.78% weighting in total return swaps. That's leveraged against the treasury bill positions. So it's very heavily concentrated, almost 30% in NBIS and almost the same in CoreWeave, 9.3% in shares and 14% in total return swaps. And then the total exposure to IREN's about 10%. So between the 3 of these, 70% of it's in these 3 holdings. So much different ETF. And all 3 of these names really are the leaders right now as we see it. So let's go into each one of these, starting with NBIS. NBIS just had a huge report, huge gap open, and really had a massive high volume day, the biggest volume ever on their earnings report. And this is quite notable. Don jumped on this right away, got a starter position for Grotection, but it just exploded on Wednesday. And we really like the fact that it was just a huge beat and raise report and the biggest volume ever traded on this name, kicking it back above the 50-day moving average. So again, this is the leading name in the NCLD. And the second leading name is CoreWeave, which also had a very good report as well. Again, gap up on Wednesday. Really, the notable thing with this earnings report, they reported a backlog of over $100 billion, which was well above expectations. So, again, currently gapping through all the key moving averages, gapping up through the 50-day moving average, and really just consolidating pretty nicely in this gap. A little bit lower right now than the opening low of the earnings gap, which, again, we don't necessarily love to see. We like to see them holding above that, but the day's not over, so we'll see how this one trades going into the close and into the end of the week. And IREN being the smallest position in this ETF, they actually have not had earnings yet, but they had a big announcement also this week. They delivered on their Horizon contract with Microsoft. They had a $10 billion deal with Microsoft where they've just announced this week that they've delivered the first tranche of 50 megawatts to Microsoft. So 1/4 of that deal has been delivered, fulfilling that portion of the NeoCloud deal. So that was on schedule and good news in general. So these three names dominate this NCLD. It is a nuanced ETF. It has derivatives in it. So beware of that. It is not a clean ETF with just share representation. It does use the swaps, the leverage, so it has some derivative risk, counterparty risk to it. So we're going to have to see how this thing trades over the upcoming days. But if you want the juice into the pure NeoClouds and these top three NeoClouds, this is the ETF to buy.
NCLD. That's right. We complained internally for a while about the way that the WGMI had its weightings, but much more attractive despite the fact that it's new. But it's certainly liquid. It's already traded 663,000 shares today, slightly after noon Eastern time. Good stuff there, Todd. Thank you very much, folks. And that was a breakdown of the three of the key ETFs that you can watch to keep your finger on the pulse of AI. Let's take a look at two other ones that are always at the top of our watch list. The first one is SOX, obviously with semiconductors being a huge component of AI, and semiconductors doing what most AI stocks are doing, and that's trying to come up the right side of the base. For now, ran into the declining 50-day moving average, and then several software ETFs that we monitor. Software basically broken down into three different components. IGV is the big enterprise type software names like Microsoft. There are two cloud ETFs that I track, CLOU. You can see that made a new high and then reversed today. A lot of strength on that over the last 3 weeks. I also keep an eye on Sky. The difference is just the components of the two ETFs, very similar chart there. And then finally, cybersecurity, CIBR, is my preferred ETF for that. But with a few ETFs, you can always take a look at them and get generally a good idea of how the AI trade is going. And if you want a further breakdown, we provide the return of our Revere AI 100 index in every one of our videos at night. Let's go back to take one last look at the indexes. S&P 500 trading around 77.85. Still an inside day compared to yesterday. Nice range contraction over the last week and a half. We like to see that. And the VIX at 1450 is confirming that contraction. The VIX looks out the next 30 days and forecasts. You take what it's trading at, divide it by 16, and that's a rule to determine what the market is looking at from a volatility standpoint over the next 30 days. That's it. I'm going to send it back to the legendary spirit of Dan to close our show. Thanks for listening, everybody. All right, Don, thanks so much. If you like what you heard, tell your friends, tell your family, go to revereasset.com, check out our videos every night. You can get on the mailing list, send us a question. We'd love to hear from you. And we'll see you next week on Your Money, not their money, your money. Because it's not about how much you make in the market, it's about how much you